All right, let's talk about a company pretty much everyone knows, Comcast. But here's the thing. What if the story that we all have in our heads about them is just, well, wrong? We're about to dive into an analysis that says the market is completely missing the point, and we're going to break down exactly why.
So that brings us to the big question, right? We all know Comcast. They're the cable and internet guys. But could they actually be a massive hidden bargain just sitting there? According to the analysis we're digging into, the answer is a big yes.
And this right here, this is the core of it. It's like two different worlds. On one side, you've got what the market sees. Cable TV is dying, they're burning cash on streaming, and the stock's going nowhere. That's the story you read in the headlines. But then, this analysis pulls back the curtain and shows a totally different picture. A broadband business that's an absolute cash cow. A management team that's being really disciplined with that cash. And get this, a huge margin of safety. That's the tug-of-war we're going to unpack.
Okay, so to really get why there's such a big gap between those two stories, we've got to pop the hood and see what's actually powering this company. And spoiler alert, it's probably not what you're thinking.
You know, the market has this habit of getting distracted by shiny objects. In Comcast's case, it's all the drama around cable TV subscribers leaving and the money being spent on their streaming service, Peacock. But the analysis we're looking at says, hey, that's all a distraction. The real story, the absolute crown jewel of the business, is their broadband. It's not sexy, it's not flashy, it's just this incredibly stable, almost utility-like business that quietly churns out cash and pays for, well, everything else.
And when I say it churns out cash, I'm not kidding. Just look at that number, $18.13 billion. And that's free cash flow in just the last year. Let's be clear, this isn't just sales revenue. This is the actual cash left in the bank after all the bills are paid and all the necessary investments are made. That is a staggering amount of money, and it gives the company a ton of power and options.
Okay, so they're printing money. Fantastic. But a cash machine is only great if it's got a lock on the door, right? So the big question is, how durable is this whole thing? How easy is it for a competitor to just waltz in and start taking that business away?
The analysis calls it a moderate moat. Think of a castle with a decent-sized ditch around it. It's not a magical force field, but it's effective. And it's built on two really simple, powerful things. First, the sheer scale of the infrastructure. All those cables already buried in the ground. That's incredibly expensive and difficult for someone else to replicate. And second, something we can all relate to. It's just a pain to switch providers. Those switching costs are real. So yeah, threats from 5G and new fiber are out there, but this moat gives them a really solid, stable base.
So you've got this mountain of cash, over $18 billion. That's one part of the equation. The next, and arguably just as important part, is what is management doing with all that money? Are they throwing it at crazy, speculative projects, or are they giving it back to the people who actually own the company? You know, the shareholders.
And this is where a huge piece of the puzzle clicks into place, according to this analysis. The management team is being incredibly disciplined. They're not chasing flashy, high-risk growth. Instead, they're methodically sending that cash back to shareholders, either through direct dividend payments or by buying back their own stock, which makes every share that's left just a little bit more valuable.
All right, so we get it. There's a hidden cash engine. It seems pretty well protected. Now for the million-dollar question, or in this case, the billion-dollar question, what is that engine actually worth? Let's get into the valuation.
Now, before I throw a bunch of numbers at you, let's just quickly define a key term here, intrinsic value. Super simple idea, really. It has nothing to do with the stock price you see on your screen today. It's an estimate of what the business itself is truly worth, based on all the cash it's likely to produce from here on out. It's the real value, separate from the market's mood swings. And here we go, the big reveal. After running the numbers, using a method called a discounted cash flow, which is just a fancy way of saying, let's figure out what all future cash is worth in today's money, the analysis pegs the intrinsic value at around $44 a share. Now, compare that to where the stock was trading when this was done, just $30.50. That is not a small difference. That is a massive gap between what the analysis says it's worth and what the market thinks it's worth.
That gap, that 31% difference, has a name. Value investors call it the margin of safety. And it's exactly what it sounds like. It's your buffer. It's your room for error. It means that even if this $44 estimate is a little too optimistic, you've still got this huge cushion protecting you. It's like having a safety net when you're walking a tightrope.
Okay, this is all sounding pretty good. But let's be real, no investment is a sure thing. So a good analysis has to kick the tires and be brutally honest about the risks. What could actually go wrong here?
This chart does a great job of laying it all out. It's a SWOT analysis, strengths, weaknesses, opportunities, threats, but with a twist. It's weighted. You can see that the strengths, especially that massive cash flow, are given the most importance, 40%. But it's not ignoring the bad stuff. The weaknesses and threats each get a solid 20% weighting. So it's a balanced view.
So what are those big threats we need to keep an eye on? Well, the analysis points to three main things. First, cord cutting in cable TV getting even worse. Second, broadband competition getting much fiercer, especially from wireless 5G and new fiber networks. And third, the one that's always lurking for a company like this, the risk of more government regulation. Those are the big storm clouds on the horizon.
This is where it gets really interesting. This chart plays out a few what-if scenarios. The base case is that $44 valuation we already talked about. But check out the bear case, the pessimistic view. Even if you assume things get tougher, that there's basically zero growth, the calculated value is still $34 a share, which, remember, is still higher than the price the stock was trading at. And of course, in a bull or optimistic scenario, the value could be as high as 55. Okay, theory is great, analysis is great, but now let's get down to brass tacks. How does any of this help you make an actual decision? Well, it all boils down to one thing: the price you pay to get in.
And the analysis we're looking at is built around a very specific goal. This isn't about trying to make a quick buck next week. The goal is to compound capital at 9% a year, on average, over a 16-year horizon. That's a long-term mindset, and having that specific goal is what determines the price you'd be willing to pay.
I love this table because it puts you in the driver's seat. It works backward from your goal. So let's say you want that 9% return over 16 years. Well, according to this math, you absolutely cannot pay more than $34 a share. Want to aim higher for a 10% return? Okay, then your buy price has to be $32 or less. It's a crystal clear link between your desired outcome and your entry price.
Now here's another layer to it: time. This table shows how your holding period changes things. If you want to hit that same 9% return, but you only plan to hold the stock for 5 years, you need to buy it for $27. But if you're in it for the long haul, say 10 years, you can pay up to $31. And for the full 16 years, you can go up to $34. It just goes to show you, time is one of the most powerful tools an investor has.
So, we've gone through the whole thing. We've looked at the cash engine, we've valued it, we've kicked the tires on the risks, and we've talked about what price makes sense. So what's the bottom line? What's the one big idea to take away from all this?
This quote just nails it. Comcast is not a growth story. It is a valuation story. What does that mean? It means you're not betting on this company to be the next big thing, to grow to the moon. No. The bet here, according to the analysis, is that you're buying a really solid, cash-producing business for way less than it's actually worth. The opportunity is in the price, not the promise of explosive growth.
All right, so let's wrap this up with your key takeaways. What should you remember from this deep dive? Number 1, ignore the headlines and focus on the real cash engine, which is the broadband business. Number 2, this is a marathon, not a sprint. The value gets unlocked over time through things like dividends and buybacks. And number 3, and this is probably the most important part, know what you want to achieve, your target return, and don't pay a penny more than the price that gets you there.